This man is standing on a mountain of gold. By every accounting rule on earth, he is rich. He is also in the middle of a desert, and his water jug is empty. No one out here will trade a single drop for gold he can't hand over fast enough. He'll be dead by Friday, and his balance sheet will still say he's winning. Today we're talking about the most dangerous gap in all of money, the gap between profit and cash flow. Because profit is a story you tell on paper. Cash flow is whether you survive the week. And this isn't some small technicality that only accountants care about. The majority of small businesses that die don't die because the idea was bad. One widely cited study found that about 82% of failed businesses point to cash flow problems as a reason they went under. Many of them were profitable on paper the very day they closed. They died rich and thirsty. To understand how that's even possible, you need to see how money actually moves. Because the number on a profit report and the money in a bank account are two completely different animals. One is a scorecard, the other is oxygen. Here's the piece of accounting that creates the whole illusion. Most businesses use something called accrual accounting. Under accrual rules, you record revenue the moment you earn it, not the moment the money actually arrives. Sign a deal in January, and January's books proudly show the revenue, even if the customer doesn't actually pay you until April. So a business can be booking win after win while its bank account quietly starves. Let's define the two players properly, because the words get used interchangeably and they shouldn't be. Profit is revenue minus expenses, measured on paper, over a period of time. Cash flow is the actual money moving in and out of your account in real time. Profit asks, did we create value? Cash flow asks, can we pay for things today? Those sound like the same question. They are not even close. Which brings us to the question this whole video hangs on. How does a profitable business actually die? The answer, almost every time, comes down to one word: timing. Money has a timestamp, and the timestamp matters just as much as the amount. $1,000 arriving in 90 days cannot pay a bill that is due on Friday. On paper, those are the same $1,000. In real life, one of them keeps the lights on, and the other one doesn't exist yet. Let me make this painfully concrete. Meet a furniture maker who just landed the biggest order of his life. A custom table sold for $10,000. The wood and materials cost him $6,000. That's $4,000 of profit, and the books celebrate immediately. But the customer, a fancy hotel, pays its invoices in 60 days. Meanwhile, the lumberyard wanted its $6,000 up front in cash. So right now, this profitable man is $6,000 poorer than when he started. Rent is due, payroll is due. The saw blade just broke. The profit is completely real. It's just trapped 60 days in the future. And the desert doesn't take IOUs. It actually gets worse before it gets better, because success invites more of itself. Word spreads, and 2 more hotels place orders the very next week. More profit on paper, and even more cash walking out the door for wood, up front. Our furniture maker is now the proud owner of the best-looking bankruptcy in town. Remember that image because we're coming back to it. This is the core mechanic of the whole video, so let's slow down on it. Profit is a verdict, delivered after the fact. Cash flow is a heartbeat, and it has to happen continuously. You can survive a bad verdict. You cannot survive a skipped heartbeat. So from here on, picture your money like this. Your business or your life is a water tank standing in the desert. Cash coming in is water pouring into the top. Expenses are a tap at the bottom that never fully closes. Rent drips out. Payroll drips out. Subscriptions drip out whether you're watching or not. Profit is the gold piling up next to the tank. Beautiful. Valuable. Completely undrinkable. The only number that decides whether you live is the water line. And the water line does not care how tall the gold pile is. Now, if this sounds like a small business problem, history disagrees. In 1975, an American retail giant called W.T. Grant collapsed in one of the biggest bankruptcies of its era. For years before it fell, its income statements showed profits. But researchers who went back through the books found its actual operating cash flow had been negative for years. The scoreboard said winning. The tank had been draining the entire time. Over 1,000 stores, decades of history, gone, with profit still on the books. And here's the twist that catches even the smartest operators. Growth makes this problem worse, not better. Every new order means buying materials now for money that arrives later. Every new hire means payroll today for productivity that shows up next quarter. The faster you grow, the wider the gap between cash going out and cash coming in, which means a business can literally grow itself to death, drowning in orders and dying of thirst at the exact same time. Now, the obvious objection. If the profit is real, can't you just borrow against it? Get a loan, bridge the gap, problem solved. And sometimes, yes, that is exactly what credit lines exist for. But here's the cruel joke of lending. Banks are happiest to hand you an umbrella while the sun is out. The moment you actually need the cash, when the tank is low and payments are late, is precisely when lenders get nervous. Credit tends to dry up at the same speed as your cash does. So, counting on a loan to save you is planning to go find water after the thirst hits. This pattern isn't unique to money, by the way. Your own body runs the exact same system. You can carry weeks of stored energy around as fat. But if oxygen stops flowing for just a few minutes, all of those reserves mean nothing. Stored wealth is fat. Cash flow is breathing. Nobody has ever suffocated their way to safety by being well fed. And this scales all the way down to your own kitchen table. Think of the family that is house rich and cash poor. $300,000 of home equity and total panic when the transmission dies. Or the worker with a six-figure retirement account who can't cover a surprise $400 bill this month. Freelancers live this exact story on hard mode. You can book your best quarter ever and still sweat the rent because 3 clients all pay on net 60 terms. The work is done. The value exists. The water just hasn't arrived yet. Income on paper. Instant noodles in the kitchen. On paper, these people are doing everything right. In the desert, they are standing on gold with an empty jug. So here is the pattern underneath all of it. The value of money depends on when it exists, not just how much of it exists. A dollar you can touch today and a dollar promised next quarter are 2 different species. Accounting treats them as equals. Reality never has. And once you see that, you understand something much bigger about the entire financial world. Liquidity, the ability to turn value into spendable cash right now, always trades at a premium. It's why cash in a checking account earns less than money locked away in investments. You are paying for the privilege of instant water. It's why cash is king isn't a cliche. It's a survival observation. The whole financial system is, at its core, a machine for moving money through time. And nearly every financial crisis you've ever read about was, underneath the headlines, a moment when too many people needed water on the same day. Bank runs, credit crunches, margin calls, they are all the same picture. Plenty of gold in the system and not enough water in anyone's tank on the one day it mattered. Everyone on the street is rich and nobody on the street can buy lunch. So what does all of this mean for you, standing in your own personal desert? It means your net worth is not your safety. Your retirement account, your home equity, your someday money. That is the gold pile. Your safety is the waterline, the cash you can actually reach this week without selling anything or begging anyone. That is what an emergency fund actually is. Not an investment, not lazy money sitting around earning nothing. It is the water tank, and its entire job is to be boring and full. So say it with me because this is the whole video in one line. Profit is the prize. Cash flow is the lifeblood. The prize is why you play the game. The lifeblood is how you survive to the next round. Here is how you actually apply this, in 3 moves. Rule 1. Know your waterline. Once a week, look at your actual available cash, not your net worth, not the invoices owed to you, just what is drinkable today. Businesses call this a cash flow statement. You can just call it checking the tank. Rule 2. Match your timing. Pull your money in closer, invoice immediately, ask for deposits, get paid up front wherever you can. Push your money out further, negotiate payment terms, spread the big bills, delay whatever can be delayed without penalty. The game is not only earning more, it is tightening the gap between out and in. Rule 3. Keep survival water. For a household, that means 3 to 6 months of expenses in boring, reachable cash. For a business, it means enough runway to survive your slowest season, plus 1 disaster. and keep that reserve somewhere boring on purpose, a plain savings account you can reach within a day. Not stocks, not crypto, not locked behind withdrawal penalties. The moment your survival water needs a good market day to exist, it isn't survival water anymore. The gold pile can wait. The tank cannot. Because here's the thing about deserts. Nobody out there sells water for gold you will have next month. Every business that ever died profitable learned that lesson exactly 1 week too late. You now know it for free. Keep the prize in your sights and keep the tank full. If this reframed how you look at your own money, subscribe. Because next time we are following the water itself, where cash actually hides inside a business, and how the pros keep it flowing. Until then, go check your tank.